Silver markets are showing significant resilience tonight, as prices continue to recover from repeated intraday pullbacks, while the convergence of physical supply pressures, geopolitical developments, and broader capital market shifts draws growing attention from analysts and investors alike. As of this report, Western spot silver is sitting at $88.50 per ounce. Western silver futures are priced at $88. Shanghai spot silver came in at $86, with Shanghai futures also at $88. Notably, tonight marks the first reopening of the Shanghai Futures Exchange since the Lunar New Year holiday, a development the market has been closely monitoring. Throughout today's trading session, silver prices were pushed down to an $85 handle on multiple occasions. Each time, the price recovered, ultimately reclaiming the $88.50 level on Western spot. Gold, meanwhile, is trading at $5,228 on Western spot. Looking at a two-session window, the moves in both metals have been substantial. Over the past two trading days, gold has risen approximately 4%, while silver has climbed more than 11% over that same period. Bitcoin, by contrast, declined during that same window. Beyond the price action itself, a series of structural developments in both the physical silver market and the broader macroeconomic environment are unfolding simultaneously, from warehouse inventory drains at the COMEX to a significant short position on the Shanghai Futures Exchange, to geopolitical tensions spanning Mexico, the Middle East, and global trade policy. Beginning with the technical picture, silver is currently trading inside a resistance zone that was previously identified between $87.20 and $89. As of this report, price remains within that zone. Analysts watching the short-term price structure note that no hourly body close above $89 has yet been confirmed. The distinction between a body close and a momentary price print or wick is considered significant in this context. Without a decisive body close above that $89 level, the resistance zone remains technically intact, giving sellers the opportunity to reload positions. Should a confirmed body close above $89 occur, the next structural levels being watched are $90, followed by $92. Until that confirmation arrives, the zone continues to function as overhead resistance. Turning to the options market, silver's COMEX implied volatility index has broken above 100 once again. This measure functions similarly to a fear gauge for the silver options market. When the index reaches elevated levels such as this, it indicates that the options market is pricing in the possibility of significant and potentially disorderly price moves ahead. Importantly, the implied volatility reading does not indicate direction. It reflects the degree of stress and uncertainty being priced into the structure of the market. A key data point adding to that stress is the state of March silver open interest. With 3 trading days remaining before first notice day, open interest is still sitting at 44,500 contracts. That figure represents more than 223 million ounces of paper silver. Open interest did decline by approximately 3,300 contracts on Friday, but the amount still outstanding heading into first notice day remains substantial. Under normal market functioning, the majority of those positions are expected to roll or close without resulting in physical delivery. However, any contracts that do not roll convert into physical delivery demands. COMEX February. Silver deliveries have already reached 23.5 million ounces for the month, confirming that the physical delivery pipeline is actively in use. On the Shanghai Futures Exchange side of the equation, a specific position has drawn regulatory attention. A Chinese billionaire identified as Beyond Shiming holds the largest naked short position on the SHFE, 450 metric tons short, against total exchange inventory of approximately 350 metric tons. That short position is larger than all of the physical silver currently held on the exchange. Regulators have responded by freezing his ability to add to the position and raising margin requirements. While hedging is theoretically possible, the scale of the position, the absence of a physical buffer, and cross-exchange capital requirements mean that any exit from that position is not straightforward. The Shanghai Futures Exchange reopens tonight, and market participants are watching closely to see how that situation develops. The physical silver story does not stop at open interest and short positions. On Friday alone, 2.25 million ounces were withdrawn from COMEX silver warehouses. Institutions involved in those withdrawals included CNT, Delaware HSBC, and JP Morgan. Total COMEX silver inventory now stands at 364 million ounces. The pace of withdrawals has not slowed. On the supply side, global silver production reached its peak back in 2016, and that level is not expected to be matched again until 2030. During that same period, the composition of silver demand has shifted considerably. Industrial demand has grown from 47% of total silver consumption to 67%, driven by sectors including solar energy, electric vehicles, data centers, defense, and consumer electronics. Supply growth has not kept pace with that demand expansion. and the market has recorded deficits for 5 consecutive years. The current paper pricing of silver has not yet reflected that underlying supply and demand reality, according to the data being cited. Regarding Mexico, the situation on the ground involves the departure of a figure identified as ELRO. Road blockages, halted mining operations, and cartel activity, including the extortion of shipments in affected regions. Mexico supplies approximately 45 to 50% of United States silver imports and produces roughly 1 in 4 ounces of silver mined globally. Whether the current instability translates into confirmed supply disruption in actual mine output data remains an open question at this time. Adding a new dimension to that situation, President Trump publicly stated that if Mexico wanted assistance dealing with the cartels, the United States would be, in his words, honored to go in and do it. That statement represents an openly expressed willingness by the current U.S. administration to consider military involvement in Mexico in relation to cartel activity. On the trade policy front, President Trump has threatened significantly higher tariffs against the European Union. The threat came in response to the EU's decision to freeze ratification of a trade agreement with the United States, following a Supreme Court decision. Trump's public framing indicated the United States would respond more forcefully than before if countries were perceived as acting in bad faith. Separately, United States military hardware in the Middle East remains at elevated positioning levels. The situation involving Iran has not been resolved and is described as having paused rather than concluded. Turning to broader market conditions, Anthropic launched a product called Claude Code. The downstream impact on specific sectors has been notable. Cybersecurity stocks saw more than $52 billion wiped from their valuations over 2 trading sessions. CrowdStrike fell 20%. Cloudflare dropped more than 18%. IBM declined 10%, specifically on news that Claude Code is capable of converting legacy COBOL code, which directly targets IBM's core code modernization business. Bitcoin fell below $64,000 as leveraged liquidations accelerated during the same period. During the same window, gold added over $500 billion to its market capitalization in a single hour. Silver added approximately $130 billion in that same time frame. Chinese investors have also been active in the gold market, with the World Gold Council describing the pace of Chinese gold ETF purchases as historic. Chinese gold ETF holdings rose 52% between late August 2025 and the end of January 2026. The gold-to-silver ratio, which had remained in a range between 80 and 100 for several years, dropped to 44-1 when silver spiked to $120 on January 26th. The ratio has since moved back to approximately 60-1. That compression from 100 down to 44, and its current stabilization in the 60s, represents a notable shift in how silver has been performing relative to gold compared to most of the previous decade. On the question of risk, it is noted that the COMEX implied volatility spike reflects the pricing of violent moves in either direction, not exclusively upward. A coordinated response from large institutional players, or a liquidity event in another asset class, could push silver prices sharply lower in the short term. The Shanghai Futures Exchange reopening could proceed with more caution than physical demand signals might suggest. And while the Mexico supply disruption presents a directional risk, confirmed impact on actual mine output data has not yet been documented. As this report draws to a close, 2 distinct but interconnected forces are converging in the silver market simultaneously, and together they form the core of what analysts and market participants are focused on heading into tonight, the Shanghai Futures Exchange reopening. The first is the physical silver market itself. By multiple measurable indicators, the physical market is structurally tighter than current paper pricing reflects. COMEX February. Silver deliveries have reached 23.5 million ounces this month. March open interest, with 3 trading days before First Notice Day, remains at 44,500 contracts, representing more than 223 million ounces of paper silver. COMEX warehouse withdrawals totaled 2.25 million ounces on Friday alone, with CNT, Delaware, HSBC, and JP Morgan all recorded among the institutions involved. Total COMEX silver inventory now stands at 364 million ounces. On the Shanghai side, a short position of 450 metric tons held by a single entity sits against total exchange inventory of approximately 350 metric tons, with regulatory restrictions already in place, and the exchange reopening tonight into a significant price gap formed during the Lunar New Year holiday closure. The second force is the broader macroeconomic environment. Tariff escalation between the United States and the European Union remains active, with President Trump having publicly threatened significantly higher tariffs in response to the EU freezing ratification of a trade agreement. United States military positioning in the Middle East remains elevated, with the Iran situation described as paused rather than resolved. Geopolitical uncertainty surrounding Mexico, which supplies 45 to 50% of United States silver imports and produces approximately 1 in 4 ounces of silver mined globally, has escalated to the point where the current United States administration has openly discussed the possibility of military involvement related to cartel activity. Equity markets have seen significant sector-level declines following the launch of Anthropic's Claude Code product, with more than $52 billion erased from cybersecurity valuations in 2 sessions. Bitcoin has declined below $64,000 as leveraged liquidations have continued. Meanwhile, gold has added over $500 billion to its market capitalization in a single hour, and silver has added approximately $130 billion in that same window. Chinese gold ETF holdings have risen 52% between late August 2025 and the end of January 2026, a pace the World Gold Council has described as historic. Underlying all of this is a supply and demand structure that has recorded 5 consecutive years of market deficits. Global silver production peaked in 2016 and is not projected to return to that level until 2030. Industrial demand has risen from 47% to 67% of total silver consumption, driven by solar energy, electric vehicles, data centers, defense, and electronics. The paper market has not yet fully reflected that reality in pricing, according to the data and figures cited in this report. What remains to be determined is whether tonight's reopening of the Shanghai Futures Exchange will confirm or contradict what the physical market appears to be pricing in. That data will become available in the hours ahead. All figures referenced in this report, including CME data, World Gold Council publications, and Silver Institute supply and demand figures, are publicly available for independent verification. That concludes this market report. All data, figures, names, and developments referenced throughout this broadcast are drawn directly from the source material and are presented here for informational purposes only. This report does not constitute financial advice. Viewers are encouraged to consult publicly available data sources and conduct their own independent research before making any financial decisions. We will continue to monitor developments as they unfold. Thank you for watching.